How's it going, guys? Today is March 2nd. Can't believe we're in March already. 2:31 p.m. here on the East Coast. So today's vlog is about finances. Now, there's so much that can be said about finances, but there's a couple of things that I want, I guess, people to be aware of that I've noticed in my opinion over time. So, um, when I got into the financial arena was probably back in 2003. I was, let me see, 10. I think I was like around 18 at that point. And I had went into my first bank, um, and I'm talking about this stuff because I recently had bad interaction with my bank, and then just noticed a lot of things along my life that have to do with finances. So I ended up opening my first bank account in 2003, which unfortunately today I closed because we just weren't seeing eye to eye anymore. I felt like the bank just wasn't treating me fairly anymore, and I have a couple different accounts with a couple different banks, which is what I recommend. So you're never really tied into one particular bank, and you don't have anything to lose by, if I have an issue with a bank like I did with the first bank that I've signed up for, and I have to close that account, then so be it. I just transfer money out, put it in a different account, and continue on with life. It's not that big of a hiccup. Um, I also recommend joining credit unions. They seem to offer the best rates. Whenever I was shopping for motorcycle, when I was looking to purchase one back in 2013, I went to my bank and a couple of banks that I bank with, and nobody could touch the interest rate that was offered to me from a particular credit union that I found in the place I was stationed at back then in Colorado. So credit unions do offer the best interest rates, in my opinion, and I would suggest you bank with a couple of them. I don't necessarily use them for my banking needs, more so for my lending needs, just because they do offer better rates. It presents a little bit more complexity, but I mean, if you're going to end up saving money, and by complexity I just mean another account to manage, but in the end, you'll end up saving money, and possibly a lot of it. Their interest rate back then for a motorcycle that I was buying at best was like 6 or 7%. And the bank that I went with, I believe, was at 3 or 4%. So that difference of, from 3 to 6 is double the interest that it would be at 3%. So I definitely decided to go with them, and it saves me, you know, uh, pennies on the dollar, but to me, you'll have to be penny wise and dollar wise. A lot of people today are penny wise and dollar foolish. They will pinch pennies and clip coupons and do all this other stuff to save pennies, but they'll blow $1,000 on, maybe something that they don't necessarily need. And when it comes to being dollar wise, meaning your larger purchases, they tend to not do the same amount of investment that they would have for penny purchases or things that don't cost hundreds of dollars. So that's another key. But what I noticed in my short life thus far, like I said, I'm 31, is that the banks and a lot of lending corporations tend to lend money and provide premium interest rates to those people who don't necessarily need them. I noticed I got the best interest rates and best of everything when I was at a little bit over 800 credit score, which is very hard to do, but I was able to get there because of the steps that I took to get there, and it did take me some time to get there, and I wasn't even over 700 for quite some time. Um, but I noticed that I started getting all these offers in the mail, and when you're in that particular place, you don't necessarily, you kind of set yourself up most times to not even need the money. So the people who end up having the lower credit scores, less than, let's say, 600 or less than 500, those are the people who end up needing the loans, but they tax you so much on your interest rates that it makes it nearly impossible. And some people in those particular situations just take what they can get. I remember my first car loan, because I was trying to establish a built credit, was somewhere along the lines of 21 to 28%. It was ridiculous, but I only did it for a year and I ended up paying it off. And then you slowly progress from there. I introduced credit cards and a lot of other things of that nature. But I noticed, and it was just recently where um, last year where I hit over an 800 credit score and I started getting all these cool offers and things of that nature. And to be honest with you, you don't need a credit score above a 720. Anything above a 720, in my opinion, gets you premium rate. So anything above that it just shows that you have, high discipline when it comes to managing your finances, but it doesn't necessarily give you anything more. I've found, I had my credit scores in the 718 range, and when I was going to lease a car, I was still able to come in at a tier one because it was over 700, put you at a tier one, which is the best uh, financing options that you can get. And I get the bank's point of view that you're low risk and things of that nature, but what if you're trying to establish yourself and you don't have the credit? Or what if you made, like the millions of Americans that are out there, a simple mistake that doesn't, that you weren't able to control? Why should you be judged on that criteria? You should be judged on your on what you can afford today. And that goes with a lot. I notice that a lot of people do live outside of their means. They get into these houses and these cars that they can't necessarily afford. So that's another piece of advice. Definitely live within your means. If you're not, budget conscious of what you're spending on a monthly basis, I suggest you start writing it down so you can see exactly where your money goes. And you don't live like a majority of my friends and family that just live from paycheck to paycheck because they're not tracking where their money goes. If you can calculate things like how much you're spending on gas and how much you're spending on food and rent and some of the necessities that you need, you can figure out exactly how much money you have left over to spend on a bi-monthly basis or every time you get paid. You see your residual and that's what you have to spend. I suggest you take that residual, take it out in cash, put it in your wallet, and once you're done spending that, you're out of money and you can see that. I think a lot of the confusion we have today is we move to debit and credit cards where you can't necessarily see the money that you're spending. So when I've tried to help people in the past manage their finances, I say, okay, let's get your bills paid first. So after your bills are paid, let's say every 2 weeks you get paid. After your bills are paid, you take out the residual money that you have left over. Now this is what I call, so you pay your bills first, and including in your bills, you should separate some savings. I take a certain percentage of what I get paid or a certain amount. Whatever you feel comfortable with. I would say at least 10% though. At the very least 10%, set that aside for savings in an account, and you use that. You think of it like another monthly payment. You just add it on to your monthly bills, and then you build up a savings account. It may not be much at a time, but at the end of the year, it'll be a couple $100. If that, if not, it'll be $800 or whatever you can save up. I mean, to each their own, and you find something that you're comfortable with. So after you pay your bills, after you set aside some money for savings, you take out the residual money, and that's the money that you have to spend on stuff. And I suggest you take it out. What I've done before in the past is take it out in cash so you can see it. You see the denominations you have. As you spend money, you see it physically leaving your hand, and there's some sort of emotional connection there that I think that the majority of people can computate and the brain recognizes. As you see the money starting to diminish, you either have to slow down your pace until your next payday, or you can maintain that pace depending on how much you have left. So there's a lot of different ways to do that. That's what I recommend for people who have problems keeping up with their finances and doing it that way. Pay your bills first, pay yourself second. By yourself, I mean your savings account. And then thirdly, take out the residual money that you have left over, and that's what you have till the next time you get paid. And you can see that money in cash leaving your hand. Because if you can't track it by a debit card, I know that a majority of people don't balance a checkbook. I'm the type of person who does. I always have since I opened my first account back in 2003. And it's grown a habit on me. I do it every single day. I will never be a victim of identity theft. And if I am, I catch it within 24 hours because I monitor every single one of my accounts on a 24-hour basis. So if I don't happen to catch it in that instance, and I have been a victim of it before, I've caught it within a couple of hours, and I have the credit card or account associated with it shut down, and then I'm reimbursed and I've just reopened another account. It's very common today, and that's not to say even people with great credit or no credit or terrible credit, they can be a victim of identity theft altogether. So be very conscientious of that and monitor your accounts at all times. And you just do that to protect yourself. And monitoring your accounts will create good habits that lead you to getting good credit scores. But like I said, a majority of people who have excellent, good, are over that threshold of, let's say, 700, they don't necessarily need loans. And if they do, they're kind of in a predicament. Like I was just leasing a car a couple months ago back in January, and I had an excellent credit score, and I knew it, and that provides me leverage whenever I go into a dealership per se, or I go in to buy something that costs a couple of thousands of dollars, and I'm looking to finance it, or I'm looking to lease it. It provides me some leverage. I know that I'm going to be coming in at a tier 1. So you tell me whatever your tier 1 rates are, and we can work backwards from there. You know what I mean? Running my credit isn't going to change a whole lot of different things if I know where my credit is at. And you can use that as a negotiating tactic whenever you step into places like dealerships or anywhere you finance large sums of money. If you know where your credit is at, you're a step ahead of them, because they're playing a guessing game trying to figure out where your credit is at. And 9 times out of 10, unfortunately, if your credit is a little bit not good, for lack of better words, then they end up taking advantage of you, and it's very unfortunate. I see a lot of people get a lot of credit cards, and they said the average interest rate for, like, I think somebody just starting out or getting a new loan was like 18%, somewhere around 18 to 21%. And I thought that was outrageous. If I were to read a credit card or sign something for 18%, you got to be out of your mind. I would never sign that type of deal. But to see that averages just means that people aren't paying attention to it, in my opinion. It's not like they're 18% were, 18 times riskier than, let's say, a person with perfect credit score who gets a 0% or 0.9%. In my opinion, it's not that. And those people need the loans more than anybody else. So why not give it to them and try? I mean, I had a friend who worked in the car business, and if he would deal with these type of people who had not so well credit and things of that nature. And when it came to the car business, if they didn't pay their note, he just repo the car. It was a win-win for him. And the same thing holds true for the larger car businesses. They hold the right to repo the car if you don't pay it. It's you're not paying them for what you said you were going to pay them, so they take it back. And that holds true for a lot of different things that you can purchase in large sums of money. Boats, cars, even furniture has been taken back before, believe it or not. So, and they just end up reselling it and making more money off of it. So what you thought was, in my opinion, what you thought was a high risk ended up paying more in the long run, because a person that was low risk, you make less money off of them, but you don't have to deal with, let's say, repoing the car and things of that nature, but they do end up making, let's say, double the money they would have made if they do repo the car, boat, or furniture, because they end up reselling it. And these are just a lot of the things that I've learned along the way. I've worked in a dealership setting, never as a salesperson, but as a lot manager, and have had friends and have friends who own dealerships, both small scale and large scale. So I know the ins and outs of the business, and I never, I have been taken advantage of in the past when I didn't know these people, but now in the future I come well prepared whenever I come to a type of deal or anything of that nature when it comes into the dealership arena. So those are just a couple of things I want to leave you with in regards to finance. Definitely I gave you some tips there to be successful, manage your finances, living within your bubble, making sure that you can do certain things. And there's a lot of different ways to do it. You can research hundreds of different ways to do it. I just tell you what worked for me and what worked for me to get above an 800 credit score. And for me, that was a huge plus, and made life a little bit easier. But I noticed at that point I didn't necessarily need loans. I didn't need people to lend me money at that point when I was there. People in that predicament tend to be better off, and they've managed their money so well. And the other thing I will tell you is that there was a huge myth that I had heard for quite some time, that you can't get above a 800 or even high seven sometimes. I'm talking about like 790, maybe 785 plus, unless you have a mortgage out on your in your name. So I found that myth out to be false because I was able to do that, and I've never had a mortgage in my name. And it was just a matter of having a very low um, debt ratio to what you have revolving. So let's say I was using 10% of my credit cards on a monthly basis. That's when my credit score, even 5%, or if I paid them off anywhere below 10%, I noticed that increase in above 800. And I thought for the longest time that that wouldn't be possible, because I heard from even professionals that you do need a mortgage. You need a lot of different types of accounts. And but what I mean by that are like credit cards, car loans, student loans, mortgages, and a lot of different types of accounts. So you have variety in your account in order to build your credit. And I did find that true. I would sometimes, I'll give you some tips and tricks. Sometimes I would get a credit card, take advantage of the perks that they offer, like um, I don't know, $100, $100 cash back when you spend, I don't know, $500. So I would do that. I would open the account because I didn't have so many accounts at the time, and I was under the assumption that you needed more accounts and more variety accounts. So I would take advantage of the thing and keep the account open for about a year and then close the account. And now, after talking to a lot of different people and doing my own research, I have like a recommendation for the types of the accounts you should have. I would say at least one car loan. A majority of people have a student loan, so that gives you a little bit of variety. If you have a mortgage or don't, doesn't really make a difference. But rent doesn't necessarily report. They do run your credit to get into a majority of places, but after you start paying, it doesn't run unless you have a mortgage. Um, and then I would say, to protect yourself and to maximize your potential, no more than two credit cards. I have more than that now, but I'm very confident with the way I have my credit cards managed. And I don't have many more than two. But two is the maximum I would recommend, especially for somebody starting out. It's easier to maintain, keep the balances low, and you don't need a credit card with a $10,000 limit to have a 10% revolving balance. And what I mean by that is you use 10% of the card. So if you have a card with $1,000 and you use 10% of it, you don't ever have more than $100 on that card at one time. And that's how you will build your credit. And you just keep that $100 balance. You pay it off every month. A financial advisor had told me before that if you pay it off before the 30 days, you get to use a credit card, build your credit, and you will never be tacked on interest. So that's the trick. You are interest free for 30 days. I believe on the 31st day or 32nd day, that's when they hit you with the interest on the credit cards. So if you use your card and let's say on the 29th day you pay it off, regardless of what the amount is, if you do it that way. So you can use 50% of your card, pay it off within 29 days, and it will build your credit because it will show a zero balance and that you have used it but you've paid it off. And that's a great way to do it. So I had a couple of people who had the availability to put their bills on a credit card and pay it off on a monthly basis. So they would rack up everything on a credit card, and that's what I did. Once I got to a certain point, I would use my credit card for everything. If you didn't take credit card, I wouldn't necessarily pay. I would keep some cash on me in case of emergency or in those austere environments where they don't have credit card machines, just in case that situation came. But a majority of the time, I would use my credit card, and on a monthly basis, I would pay it off. And that's when I noticed a huge bump in my credit score, and I wasn't being a victim of interest rates. So they weren't able to charge me the interest because every month I would pay it off. So it showed a revolving zero balance, but if you looked into the details and the credit reporting, it showed that I did use the card and I was very responsible with it. But it showed a 0% revolving rate instead of, let's say, a 10% or a 5%. And you're never a victim of the interest rate. So that's a little trick there as well. But again, try to get different types of accounts and accounts that that you need. Don't necessarily go looking for them or applying for different things. I had a department store credit card, which I think was my first credit card, separate from my bank, just to bring a little variety. I did have student loans like a majority of people, but I ended up paying those off at a relatively young age. Car loans that I would pay off. Now, the only type of loan that I don't think I've had is a mortgage, but I have had lines of credit, which is pretty much like a credit card, except you don't necessarily have a card attached to it. So anytime I would need access to my line of credit, I would have to transfer it into the account associated with it, and then you get your money that way, and then you pay it on a monthly basis. You can do that as well. But I had several different types of accounts, and I closed a majority of them after I thought I needed to have, like, I don't know, 6 credit cards open. I ended up closing a majority of them after talking to a financial advisor who recommended I only have 2, and no more than 2. And that ends up saving your butt in the long run. And you have to have, if you need emergency funds, that's what that savings account is for. That 10%, 20%, whatever you can afford to put into it, that's what that savings account should be for emergencies. You should never have to rely on your credit cards for emergencies. Yes, they're there just in case the absolute worst happens, but that's not what you should use them for. If you want to use them on a monthly basis to pay your bills and then pay them off, that's great too. But you shouldn't use them as an emergency aspect. Another financial advisor told me you should have 6 months of income saved. That would be, in the best case scenario, something happens to you, you can't work for 6 months. You were tragically injured and you can't work for 6 months. That's a long time to recuperate, but it's a good bubble to protect yourself. And I've never been quite able to build to that, but that's another goal that I have established now, and whatever your 6 month bubble is, whatever you spend on a monthly basis, just multiply that times 6 and try to have that in a savings account, and then you can go from there. And then there's a lot of other things that a lot of other mentors along the way have taught me, like having money work for you, investing in different properties. I don't necessarily want to get into that. I just want to get into the fundamentals that help me get to the credit score that I've been at, because I've never used investment or had money work for me, so I don't want to dabble in something where I don't necessarily have experience in. I could just tell you what I used to get to where I'm at and what worked for me. But there's so much more to finances, and so much more to talk about, and so much more research to do, and the algorithms are crazy and they're constantly changing. They're always doing these certain things to measure us and judge us by our credit. But I do find it a little unfair about how people who are in privileged positions and who have the highest credit scores, granted they are low risk, but they are not the ones who necessarily need the loans. So why not even the playing field and offer those low interest rates that aren't being used to the people who may need them? And that's sometimes where cosigners come into play, but I don't necessarily cosign for a lot of people unless I'm married to you. And that's just to save my own butt. And I know a majority of people who have excellent credit, unless they're in their old age, don't necessarily cosign for other people. And it's just a matter of managing money. And there's also this old adage or old saying that says, if you don't have the money today, you're probably not going to have it tomorrow. And what I took away from that is that if you can't afford it today, you probably cannot afford it tomorrow. And that goes back to living in your bubble. If you're trying to get a car and the car payment is outside and you can't necessarily afford it today, but you think you can afford it tomorrow, don't make a decision based on that. Go with what you can afford today. And if that limits you to a car payment of $100, you find a car you can afford for $100. Then once you get yourself into a better position, then you can upgrade. But don't do it backwards. I've seen nothing but catastrophic failures, repos happen where people think they can afford something, and it's just a lack of budgeting, lack of skill in the financial area, and a lot of lack of education. One of the things I noticed that is very deprived is money management in the high school arena and in the youth today. There's not necessarily a class where they explain all these things to you, explain how to manage your money, explain you really have to go into financial management which fortunately I had, that was one of my jobs in the military. And I took it very seriously. There was budgeting involved. There was a lot of different aspects involved to the financial management technician certification that I got while I was in the military. But that's what enables me to talk to you about everything that I've learned along the way and what's kind of benefited me, and the milestones that I had to jump over in order to get and challenge some beliefs that I had, like the fact that you needed a mortgage to get over an 800. That's not true. And I'm living proof of that. And the people who can't necessarily get there, have a financial advisor take a look at you. If you're like in the 780s and you just can't figure out why you can't get over there, again, you don't need much more than a 720 to get premium rates on anything. But if you just have that milestone like I had, where I wanted to reach that credit score, then talk to a financial advisor, see what they say, and sit down with them. If you ever want to sit down with me and talk about it in depth, I'd be glad to do so. But again, I'm not a financial advisor other than the training I had in the military and some training I've had in college. I mean, and my life experience, that's what got me to where I'm at. That doesn't necessarily mean it's going to work for every single person I come into contact with, because there may be something in your history or your past that keeps revolving. And the other thing I learned is that sometimes those debts, like there was a 7-year rule where you have those debts that are supposed to fall off in 7 years. I've seen those debts of friends of mine and families be resold in that 7 years, like within 6 years. So they resell the debt within 6 years, and it just keeps on staying on your credit. If it doesn't get resold, then it falls off. But I noticed that there was like this trend of people who were like, oh, in 7 years it'll fall off. Don't worry, I got another 3 years left. Then they end up reselling the debt to somebody else for pennies on the dollar, trying to collect that debt from you, and it stays open for another 6 or 7 years until they resell it again, and that's how they're able to continually impact your credit. And that's just one of the things that I learned along the way, that if you have those types of collections, and I've had one in my past before when I was very young, just go ahead and pay it. Especially if it's a smaller one, you set aside the time and money and some of that savings in order so you can pay it, because it's going to do nothing but help you, and that's how you truly get rid of it. Because I had one that was revolving, and I paid it before year 7, around year 4, and it just got rid of it. And then within 90 days to a year later, it just absolutely rebounded. The other thing that it has, I learned when it came to timelines, is when I was closing the accounts that I had, based on my financial advisor's advice, and he was in the military, he also had over a 800 credit score. So you tend to listen to these people, but the financial advice I got from him was to close the accounts. It would negatively impact my credit initially, which I did see because I monitor my credit on a monthly basis. It's one of the features I have through one of my banks where I can do that. So as I was monitoring my credit, I did notice that it did take a dip, and then he said within 90 days it would start to come back up, and just like clockwork, within 90 days it did. And then I was able to get rid of the surplus of credit cards that I wasn't necessarily using or didn't need. I thought I needed a bunch of different credit things, but you need a variety of credit. So you can't have just a bunch of credit cards and hope to have a good credit score. You need different types of credit. So lines of credit, credit cards, school loans, car loans, mortgages, all these different types of credit. And there's more than what I'm just saying. Those are just the ones off the top of my head. But you need a variety of credit. You just don't need a multitude of credit things on your credit in order to have good credit. Really, if you keep it limited and have a good variety, that's going to be your key to success there. So again, I'm sorry this vlog was looking like it's going on 30 minutes now, but there's just so much to finances and so much more. If you guys have any questions at all, please feel free to ask, and I'll answer them in upcoming videos. But that's my knowledge on credit. Again, you don't necessarily, I notice that people don't necessarily need it as they move into the top tier credit scores, and that's very unfortunate today, because those are the people who don't need it, and the people who need it most can't get it, or they're taken advantage of heavily. And to me, that's very unfortunate, but I get the risk aspect of it. So I don't agree with it, but I understand it, why they do it that way. You just happen to be more of a risk person, so they have more chance of losing out on the money that they gave you or they lent to you when it comes to credit cards. Believe it or not, a majority of these banks, what I'm finding out recently, don't even have the money to back the lines of credit and the credit cards that they have out there, and that is truly sad because they will charge you these interest rates religiously, but they don't even have the money to back up um, the credit that is out there, and that's a little scary. So those people who are offering the credit don't even have the credit to give you, but they're doing so. So that's a whole nother problem, but that's on more of a corporate level, not on an individual level. I like to scale it down to the individual level so you guys can understand and put it into practice as best as you can. So I appreciate you guys watching, liking, commenting, subscribing. I'm up to 32 um, subscribers. I'm going on my 36th video consecutively. I'm trying to do these every day, and if I don't get a chance to, then I put up 2 the following day, but it's never gone past that. So I appreciate you guys supporting me. I'm trying to get to a goal of 50 by the end of March, so let's see if we can make that happen. Thanks again for watching, guys, and I'll see you on the next one.